Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing overbought and oversold. How can you tell when the market will reverse? To try and gauge the best way to take advantage of the market when it is overbought or oversold, we must first take a look at the biggest by volume currency pair traded in the Forex market. This is, of course, the euro versus the US dollar, a so-called major currency pair. This is a 1-hour chart of the recent price action. To establish when a pair is oversold or overbought, there are a multitude of tools available. We will focus on the oscillator and price patterns. First of all, we have the Stochastic Oscillator. This tool consists of two moving averages with a crossover at certain points, and when they move up and cross the 80 line, an asset is said to be overbought. When the moving averages move lower under the 20 line, it is said to be oversold. One of the problems with the Stochastic Oscillator, as we can see here, if we draw a magenta-colored vertical line, the market is actually oversold at a halfway point between the peak and the trough of this move. The pair continued to move lower after it's oversold. This is common with the stochastic. In this example, it has moved lower by a further 41 pips after showing it was oversold, before price action eventually does turn around and move higher. And it is then that the stochastic begins to comply with price action. One way that professional traders will guard against using the Stochastic Oscillator to get into a trade early is to wait until the indicator has gone above the 80 and its moving averages have crossed over the moved under the line. They do this before entering a short trade, or have moved up to the 20 line, crossed over, and moved above the line before they will go long. Professional traders will very rarely use a single indicator such as the stochastic on its own to enter a trade. In this ABC scenario, we have more clues about the future potential of price action. First, we have the stochastic showing an oversold position at A, and when price reverts higher to position B, price action appears to stay inflated and ignores the stochastic initially. However, when price action moves lower at position C, we have divergence in the stochastic and price action, where the stochastic has moved lower to the 20% line, and the price action at position C has moved lower to a level at position A. It has formed a higher low, and this is an indication in itself that price action may be fading to the downside, especially when coupled with the hesitation to move lower at position B, and whereby a bear candle spike outside the Bollinger Band at position C is another hint that price action may move back inside the bands, because, as you will probably know, 95% of price action will revert inside the Bollinger Bands if it spikes outside. This setup, simply by using the stochastic to show oversold, where its moving averages have moved under the 20 line, then crossed over and moved higher than the 20 line, plus the divergence in price action and a higher low setup with the candle spike outside the Bollinger Bands, has been our setup for this bull trade, which saw 140 pips to the upside. You may simply look at this setup in reverse to take on a bear trade. If you enjoyed the video, then please like and subscribe, and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.